Perhaps no other stock in recent memory has reached manic levels of hype as Nvidia has, and justifiably so. The hype was backed by real revenue growth, real earnings, and real free cash flow. The returns for investors have been staggering. The hype became so insane in mid-2024, CEO Jensen Huang was receiving rockstar treatment, mobbed by fans everywhere he went, and even signing a woman's bra. Nvidia became the first business to surpass a $4 trillion valuation. The AI train is rolling at full steam, and Nvidia is leading the way with its magical GPUs serving as the backbone for everything AI. But are cracks in the earnings starting to show? Can Nvidia sustain this growth and justify the high expectations placed on them by investors? Welcome to the Quality Investor. The Nvidia earnings has become a marquee event during earnings season. The business just released their Q2 fiscal year 2026 earnings report, and yet again, we saw stunning growth. Revenue jumped 56% year over year to $46.7 billion, and adjusted earnings per share jumped 54% to $1.05. Both beat their estimates. Nvidia is a business I've been hesitant to cover on this channel. I believe they are a high quality business. However, it has been difficult for me to wrap my head around their future growth. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. One hallmark of my investing style is predictability in future growth. Nvidia has defied the expectations recently of even the most dedicated Nvidia bulls. It was just too difficult to assess where they were going and what the market even looked like. But now it seems like we are stabilizing just a bit, if you can call 54% projected Q3 growth stabilizing, and I feel more comfortable discussing Nvidia's prospects. The biggest bellwether for Nvidia future growth is what other big tech firms are doing, or more accurately, spending. I have documented the massive CapEx spend from Amazon, Microsoft, Google, and Meta, as well as the others. Nvidia is a large beneficiary of that because much of that CapEx is going towards Nvidia's ultra expensive chips to power their AI data centers. We have gotten clarity on how the tech industry as a whole views AI. Basically, they're all in, and we are in an AI arms race in data centers. But it was the slight miss in data center revenue that triggered a modest sell-off post-earnings. The revenue there was $41.1 billion, barely missing the $41.2 billion estimate. To me, missing estimates isn't too much of a concern, but what I want to focus on is in the details of revenue this quarter. We'll go over the earnings report, discuss what the future prospects might be, and then tease out what the true intrinsic value of Nvidia really is. So, without further ado, let's dive in. The drop for Nvidia today has been fairly modest. We're only down just over 1%. So despite some initial cheering by Nvidia bears, the stock is pretty flat, and it doesn't seem like this is going to be a concern going forward at all for Nvidia. Year to date, the stock is still flourishing, up nearly 30% on the year. While not the best performer in the S&P 500 in 2025 like it has been in previous years, it is still on a historic run. Once again, the preliminary numbers for Nvidia's quarter are outstanding. We have 56% year-over-year growth in the revenue, up to $46.7 billion. They grow sequentially by 6%. Now, on a sequential basis, gross margin expanded 72.4%, up from 60.5%. There is a bit of a contraction here from the quarter a year ago. But nonetheless, coming down to the bottom line here, we see operating income, again, 53% year-over-year growth, 59% year-over-year growth in net income, and 61% growth in earnings per share. And coming down to their segments, the compute and networking segment, which is where most of these chips are being allocated to, again, we saw amazing growth, $41.3 billion in that segment, 56% year-over-year growth. But what's interesting to me, this is the first under the hood number that's not a red flag, but a sign that things are stabilizing. We look at the data center revenue, $41 billion. Again, strong 56% year-over-year growth. And the compute part of the data center, 33.8 billion, 50% year-over-year growth. But look at that sequentially. 1% decline sequentially from 34 billion last quarter. One thing that's interesting to me about Nvidia is their rocket ship-like takeoff. Nobody saw it coming. No one predicted that the demand for their chips was going to explode basically all at once. But in the same vein, no one can quite predict when that demand is going to finally plateau. And I'm not suggesting that demand's plateauing, but what I am suggesting is the demand is slowing, albeit slightly. And it's kind of brushed over here in the notes where it says, sequentially, compute revenue declined 1%, driven by $4 billion reduction in H20 sales. The type of growth that we've been seeing out of Nvidia, it's not going to last forever. At some point, it will slow down, and eventually, the demand will plateau. When that comes, we'll see. Looking at the income statement, we see that the operating income, like I said, was at 28.4 billion. Now that's a 60.8 operating margin. The operating margin for last year's same quarter operating income was at 62%. This is the first time we've really seen a decline in operating margin out of Nvidia throughout this entire growth spurt. In a year-to-date basis, with 50 billion in operating income so far, that's a 55% operating margin. But last year, same period year-to-date, was at a 63.4% operating margin. So again, we're starting to see signs that the growth is not stopping, just slowing down a little bit. And that's one aspect about investing to keep in mind, is a lot of people get so excited when they see these companies just explode. And it'll never make sense to me, but sometimes people seem to believe that these growth rates will just continue on forever. But let's be honest here. I mean, 50% year-over-year growth is simply not sustainable for any business. We all know about the massive CapEx investments big tech is making. The investment community is talking about how demand for AI and compute and all things related to AI is skyrocketing. And everyone talks about how NVIDIA is going to benefit mightily from that because they provide the chips that drive all of this AI compute. But again, looking under the hood, we can find another data point to support a slowdown in growth, or a stabilization, if you will. And that can be found here on the cash flow statement. Now, they had nice operating cash from activities, 26.4 billion. All the other numbers here above working capital fairly in line with last year. But let's look at inventories. Cash decreased because of $3.6 billion increase this quarter in inventory. And on a year-to-date basis, we had a $4.8 billion increase in inventory. So when we see a working asset, such as inventory, decrease our cash, a negative 3.6 billion, a decrease to cash, that means that asset itself increased on the balance sheet. And sure enough, coming up to the balance sheet, we can see inventories, 14.9 billion, up from 10 billion at the year end. So a theme with Nvidia is how their chips are in such high demand, but we are seeing elevated inventory compared to last year. Again, not a red flag in and of itself, just an indication that things are slowing down, starting to stabilize a bit for Nvidia. But what makes this increase in working capital interesting, it caused Nvidia to have its lowest quarterly free cash flow total since January of 2024. Free cash flow, taking that 15.3 in operating cash less the 1.894 billion in purchase of property and equipment, came in at $13.5 billion. That's actually a slight decrease from last year, year over year, and the free cash flow margin this quarter is at 28.8%, down from 45% the same quarter a year ago. But when we see net income grow 60% year over year, yet our operating cash only sees 6% growth year over year, and it's a sign of things slowing down a bit. Touching on the guidance for a second, we can see that the revenue is expected to be 54 billion in Q3. But what's important here is the company has not assumed any H20 shipments to China. So we know the Trump administration just allowed Nvidia to sell its H20 chips to China, and Nvidia smartly is taking the conservative approach and not guiding for that. But that could be a reason for the inventory buildup. They didn't touch on the inventory buildup on the earnings call, but a potential reason for that is because they're building up for the expected sales to China. We shall see how that plays out next quarter. We went over the numbers for this quarter, and again, it was a very good quarter. But now I want to touch on what the future might hold for Nvidia. Growth in and of itself will slow down. Not going to slow down to like 5% a year. It'll slow down to less than 50%, but probably settle between 15 to 20% over the next couple of years and be 10 to 15% in the medium to long term. But there are some risks here, and that's what I want to caution people towards if you're thinking about adding Nvidia to your portfolio to really not get caught up in the hype, because there's still hype there. They just had another quarter where they grew over 50%. And to me, this tweet highlights a pretty significant risk. The biggest risk for AI infrastructure companies is the customer concentration. Nvidia generated 44% of its revenue from 2 customers last quarter, one of them likely being Microsoft. CoreWeave generated 72% of its revenue from Microsoft. Once the hyperscalers back up a bit, the AI boom can easily turn into an AI collapse. Right now, we are seeing heavy investment in the form of CapEx from big tech and other businesses out there into AI infrastructure, data centers. That elevated CapEx spend will not last forever. That is for sure. Now, I know in the earnings call, Jensen Huang said he expects $3 to $4 trillion of AI spend through 2030. And I'm not sure if he's including the 600 million or so that we're seeing out of just Microsoft, Google, Amazon, and Meta. That is a very small amount of customers, and you don't want your business to rely on that for the long term. It might help in the short term a little bit. It certainly is helping for Nvidia. But long term, that's not a sustainable business plan. And you can see the highlighted part here. Customer A represented 23% of total revenue, and sales to a second direct customer, Customer B, represented 16%. It's a very concentrated risk right there. And that leads me to another interesting discussion I saw on X yesterday as well. For context, I want to highlight this tweet from Joseph Carlson. For those wondering why Costco trades a higher valuation than Nvidia, here are some things to consider. Costco didn't 5x its revenue in just 2 years. Instead, over the past 25 years, it has steadily grown revenue at 12% annually with a sticky, subscription-driven model. It's the definition of reliable and predictable growth. Nvidia, by contrast, captured most of its growth in just the past few years. Costco's revenue is diversified across 140 million members, while Nvidia's revenue is heavily concentrated in the CapEx budgets of just a handful of tech giants. Now, I'm not going to get into the Costco versus Nvidia valuation comparison. I just wanted to set the context for the tweet I'm about to show you. This comes from Stephen Fiorillo. Hello, Joseph. I read your tweet about the cost valuation, and I'm going to push back a bit. Now, he agrees that Nvidia is benefiting from the CapEx expansion from the big tech companies, but he also posits that they're caught in a prisoner's dilemma, and they're unable to take their foot off the gas. In Q2 of 2024, the combined CapEx spend from these 4 companies was $52.85 billion. In Q2 of 2025, this increased 67% to $88.25 billion. And each of these companies have committed continued CapEx allocations going forward. And then he says none of these companies can stop spending unless they all stop spending, which from the commentary on all of their earnings call isn't going to happen anytime soon. Now, I agree with the anytime soon part. However, I'm defining soon as within the next 3 years or so. CapEx cycles tend to last 2 to 3 years. So if we're in year 1 of these cycles now, we have about 2 years left. 3 if you're being optimistic, which means, yeah, Nvidia is going to grow 20+% for the next couple of years. But that growth is not going to be sustainable after year 3 or so. He goes on to talk about Costco's valuation. I'm not going to get into that here. And then he goes on to talk about how Nvidia has grown exceptionally well over the last few years. Everybody knows this. But again, this is all past performance. He does talk about their growth estimates here a little bit, which, to be fair, are pretty optimistic. But if we're being honest with ourselves, all of this is going to end once the CapEx cycle ends, which is going to be sooner than later. And then Joseph responded. He said, okay, so to summarize, you quickly excuse the fact that Nvidia has customer concentration risk, then never addressed that it's from a historically cyclical industry, or that it faces more technological disruption, or that it's more reliant on continual difficult innovations, or that it faces more execution risk, or that it faces greater regulatory issues, or that its business model is not as predictable as subscription revenue. What you did say is that Nvidia is cheaper based on 2-year analyst estimates. And I think all the risks that Joseph mentions here are pretty accurate. They have a highly concentrated customer base. Semiconductors are very cyclical. And this right here is a risk factor I pointed out before when I've discussed Nvidia, and that's technological disruption. It may not be soon. It may not be in 3 years. It may not be in 5. It may not be in 10 years. But at some point, another business will create a chip that at least rivals Nvidia's in terms of capability. I don't know all the technical details around these chips, but if it delivers performance that's not noticeably worse than Nvidia's, and it's at a much cheaper price, people are going to buy that. A lot of people think AMD is going to be the business that creates that chip. And this is another important factor. It's more reliant on continual, difficult innovations. A business like Nvidia, to stay at the top, has to innovate constantly. It's not a set it and forget it type of business, which means they have to constantly hire the best talent. They have to be ahead of all the trends in terms of where technology is going. They can't get complacent on the growth that they just had over the last couple of years. All of that is very difficult to do. I'm not saying Nvidia can't do it, but it is a risk that you have to think about. It's just important to keep in mind not to be a blind bull when thinking through Nvidia, not to get blinded by the stunning growth that they've had over the last couple of years, but to really pay attention to what their numbers are doing, what the growth might be, what the risk factors might slow that growth down. And on that point, let's take a look at what I believe Nvidia's valuation currently is. These are the growth projections I have for Nvidia over the next 10 years. You can see the staggering growth they've had on a 5-year basis here for their compute and networking, 100% annual growth over the last 5 years. Graphics is at 13.4%. Total revenue growth over the last 5 years has been an incredible 64.24%. So on a bear case, I'm projecting compute and networking to grow 13.2% annually over the next 10 years, 16.3% on the base case, and 18.4% on the bull case. Graphics, I have 10% on the bear case over the next 10 years, 11.9% on the base case, and 13.7% on the bull case. So that comes down to 12.9% annual revenue growth over the next 10 years for the bear case, up to 18% for the bull case. This reflects what I was saying earlier. We can see very solid 20 to 25% growth over the next 3 to 4 years, but that will slow down after year 4. And when it all shakes out and you're looking at the 10-year CAGR, it can be anywhere from about a 10 to 20% on a 10-year basis. And my year 1 estimate, of course, is at 53.7% revenue growth. So they're still growing at a considerable rate. Coming down to my operating margin. Now, their operating margin has shrunk a little bit this year. On a trailing 12 basis, it's at 58%. But I do expect it to expand over the next 10 years, up to 64% on a bear case and 70% for the bull case, which ultimately brings us down to the free cash flow margin. So we have a trailing 12 free cash flow margin of 43.6%. Like I mentioned, is at 28% in Q2 of 2026. But again, they're going to continue to expand their free cash flow margin. On a bear case, I have that at 37.5%. By year 10, at 45.5% on the base case, and at 51.2% on the base case. Nvidia closed the day at $180.12, down just over 0.5% on the day. So the market pretty much shrugged off their, I guess you can call it a weak guidance. But that gives us a PE ratio of 51.3, a forward PE of 44.4. The PE ratio is slightly below their 5 and 10-year average, and the forward PE is right in between their 5 and 10-year average. Right now, based on that $180 share price, the market is pricing in 16.8% free cash flow growth over the next 10 years. About 1% higher annually than what my base case of 15.6% free cash flow growth has. But as you can see on the discounted cash flow prices, especially in the base case here, that does alter the share price quite a bit when you discount it back. So the bear case is at $97.74 for the DCF, $145.42 on the base case, and $189.11 on the bull case. The exit multiple is at $211.57. I'm using comps of Broadcom, AMD, Qualcomm, and Micron Technology. So factoring in that exit multiple comparison does bump up their valuation averages a little bit. But you can see there's quite a bit of downside on both the bear and the base case from their current share price. And if they execute phenomenally, which they've already been doing, let's be honest, that's nearly 10% upside. So without any margin of safety, I have a buy price for Nvidia at $167.92. With a 20% margin of safety, that's a buy price of $134.34. And in my view, a 20% margin of safety is fair. And I believe at $180, even with the phenomenal growth that we've been seeing recently, Nvidia has reached into the stretched valuation territory. And I've always held the contention on this channel that share price grows along with free cash flow growth. And even if we have 15.6% free cash flow growth over the next 10 years, that translates to a discounted cash flow price of $145.42. So Nvidia needs to generate far more cash to justify its current $180 valuation. And then once you factor in all the risks that I discussed earlier, it makes sense why, if you were to consider adding Nvidia to your portfolio, waiting till it came down quite a bit to less than $135 a share might be a prudent move for any quality investor out there. I want to reiterate that Nvidia itself is a quality business, but at this point, I feel like they're far too unpredictable in what their demand's going to be like in the mid to long term, and that they're also the type of business that must constantly innovate to stay on top, asking for these 25, 30, 40% growth rates year after year is just not sustainable. And once we see that real plateauing of their current demand, Nvidia's share price will come back down to reality a little bit, even if that reality is sub $150. But if you were to invest in Nvidia today, I wouldn't expect 70% annual returns like we've seen over the last 5 years. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.